Hi, dear students. Today we are going to discuss the third module, that is the leasing. In this, okay, in this lecture, we divided the lecture into five parts. That is first about the introduction, second one is the concept, and third one is what is the definition of this leasing. And in the fourth part, we will understand what are the various forms of leasing, and last one is what are the various classification of leasing. So first of all, introduction. As we know that leasing actually it is a unique form of intermediate term financing. Actually, in the globalization context, we know that the companies have to go global. So for this, they want to diversify, expand, and modernize their business. So in order to diversify, expand, and modernize, they want huge finance. But how to finance the this diversification, expansion, and modernization? The answer that found is that it is go for the leasing. What is the peculiarity when we go for leasing is that actually we need more amount to buy a particular machine on land, building, etc. But when we go for the leasing, we will cost only less and we can easily acquire all these assets. That's why the world is looking for the leasing to finance the diversification, expansion, and modernization. And thus, the leasing has emerged as a third important source of intermediate and long term financing in addition to the debt and equity financing. So here you can see a picture that is the Farooq Irani. He is the he is the father of Indian leasing, and he started a company called the First Leasing Company of India Limited in 1973. He is the It is the first company that initiated the leasing business in India. So that's about the introductory part. And now we are moving to the concept. What do you mean by this lease? Here I have pointed a definition, that is, it is a contract outlining the terms under which one party agrees to rent a property owned by other party. It guarantees the lessee, also known as the tenant, use an asset and guarantee the lessor, the property owner, on landlord a regular payment for a specified period in exchange. So here we can see that first of all, lease is a contractual agreement between two parties, and the first one is lessor and the second one is lessee. Okay, who is the lessor? The owner of the asset is known as the lessor, and the person who are and no, or the firm or the person who is using the property is known as the lessee. So first of all, it is a contract between the lessor and lessee. And what is this contract? What is about this contract? The contract is for using a property for a specified period of an agreed sum of rent. So it is an agreement between the lessor and lessee to use a property for a specific period and for an agreed sum of rent. So here the lessor receives the rent from the lessee for using the this specified asset. Okay, and the main advantage or the unique feature of this leasing is that we can avail the mission or anything without purchase. Okay, so this is the main advantage of the leasing, that is we can use the property without having the ownership or without purchasing it. Okay, so it provides an enterprise within the use and control over the asset without receiving the title to them. Okay, and this agreement is signed by between two parties that you already know, that is the lessor and lessee. So actually, this is happening in the real world situations whereby an asset is not purchased from the market but it is available for use for a charge known as lease rental. Okay, so the consideration here receiving the lesser from the lessee is lease rental. Okay, next portion is that the definition that laid in the Indian Accounting Standard 17. As per the Indian Accounting Standard, we can see that it is an agreement whereby the lessor conveys to lessee in return for a rent the right to use an asset for a specified period of time. That this definition we already discussed in the last slide. Okay, but as per this definition, we can see that the contract between the lessor and lessee should have some basic elements. The first one is the basic lease period. Basic lease period means at that period we cannot cancel the lease agreement. So that is the basic lease period. Okay. And the second one is the timing and the amount. Okay. At what time the lessee will pay to the lessor and what is the lease rental. So that should be in the agreement. And third one, is there any option to renew or purchase the asset at the end of basic lease period? After the basic lease period, the lessor may allow the lessee to buy the asset, or there will be an option to renew the lease agreement. Okay, and last part is that it is whether there is what whether there is any provision for the payment of cost of maintenance, repairs, tax, insurance, and other expenses. Is it to be paid by the lessor or is it to be paid by the lessee? So the provision regarding the payment of maintenance and cost, tax, insurance, etc., should also be in the lease agreement. Okay, so these four are the basic things that comes in the lease agreement. Okay, and next is that what are the various characteristics of this leasing? We already discussed that portion in the definition. Once again, I'm explaining that points. The first one is that it is a contract of commercial nature and they have two parties, that is lessor and lessee. Lessor means the owner and lessee means the person who using the asset. Okay, and second one is the periodic payment of rentals. As per the lease agreement, there would be a periodic payment of rental for using the asset for a fixed term by the lessee. And at the third characteristics is that on the expiry of the lease term, the hirer may return the asset to the owner or dispose in the manner decided by the owner. So these three are the various characteristics of leasing. And in the next slide, what we are seeing is that what are the various forms of leasing. Actually, there are three forms of leasing. The first one is the sale and lease back. Second one is direct leasing. And third one is leverage leasing. Let's see one by one. So the first one is about the sale and lease back. It's very easy to understand what you mean by this sale and leaseback. As the name suggests, the first of all, or it is an arrangement by which a firm sells an asset at a market price to another firm, which is a leasing company, and the leasing company firm leases the asset back to the former uh, for using that asset. So what happened in the sale and lease back is that first the firm selling the asset to the leasing firm, and again the firm is taking back the asset as lease. Okay, so the seller company receives the purchase consideration and also the economic use of assets during the lease period. Okay, so once when it is selling the when the firm is selling the company the asset to the leasing firm, the firm receives the purchase consideration, and during the second action, that is during the leasing time, the firm gets the economic use of assets. Okay, so these transactions helps the firms to keep the liquidity, and also either payment of the lease rental or the lease rental are 100% tax deduction. Okay, So if the firm, that is the original firm, is the owner, he will not avail this two advantages, that is the liquidity and the tax deduction. But more, if a company sells the um, asset at a price more than its written down value or the original value of asset, that the original firm may attract the capital gain tax. That is the another part. And the sale and lease back is a transaction that is suitable for those assets which doesn't have the depreciation but have uh, appreciation, like the land, etc. Okay. So, in conclusion, we can say that the lease, sale, and lease back here contains two actions, as in the name suggests. The first one is sale, and second one is the lease. What happens in the first action is that the firm is selling the asset to the leasing firm, and in the second action, we can say that the leasing back giving back the asset to the firm as lease. Okay. And the advantages is that they can enjoy, the original owner can enjoy the liquidity and also the tax deduction. And this type of leasing is suitable to the assets which are not subject to the depreciation but appreciation. And second one is that the direct leasing. Actually, here it's a very uh, it's a very convenient method of leasing, where the firm acquires the right to use an asset from the manufacturer directly. Okay. Here the manufacturer and the lessor are one and same. Actually, the manufacturer is giving the asset to the firm as part of lease. Okay. So the major type of direct leases includes the manufacturers, financiers, independent lease companies, special purpose leasing companies, etc. So here the manufacturer selling the not selling the asset, he is leasing the as he is giving the asset as lease to the firm. And manufacturer and the lessor here in this situation are same. They have no difference between the manufacturer and the lessor. The manufacturer itself is giving the asset as the lease. Okay. Thus, in the case of direct lease from the manufacturer, if the manufacturer are the and the lessor are one and the same entity. We can see various examples like IBM leases the computers, and Xerox Corporation, that is the photostat machines in USA, is that is dealing in line of Xerox Corporation in India. So in these all examples, we can see this direct leasing. Okay. And the third one is then leveraged leasing. Actually, this is also very interesting. Here also you can see the diagram. What happening in the leverage leasing is that we can find a third party called the lender beside the lessor and lessee in the leverage leasing. Actually, the lessor borrows the finance to buy the asset from the lender, and that asset is given to the lessee for using that asset. Okay. And what happening in the payment side is that the lessee first of all gives the interest to the directly pays the interest to the lender and surplus to the lessor. Okay. So here the only difference between the leverage between other leasing and leverage leasing is that we can point out one other party, that the third party, who is the lender. He will help the lessor to buy the asset or providing finance to the asset, and the lessor uh, gives the assets to the lessee, and the lessee is paying the interest directly to the lender, and the surplus after meeting the interest will give to the lessor. Okay. So the lessor, the owner of the asset, is entitled, that is the owner of the asset is entitled to depreciation allowance associated with the with this asset. Okay. So this is about the leverage leasing. And next one, we can see two main classification of leasing, that is equipment leasing and real estate leasing. So it's very easy to understand what you mean by this equipment leasing. Actually, first one is the equipment leasing. Here, the equipment leasing means the lessor and lessee are making a contract for the use of a specific asset selected from the manufacturer or vendor by the lessee. Okay, actually, so in the equipment leasing, the leasing is all about using a specific asset. Okay, here we can see that the lessor remains the owner of the specific asset, and the lessee is paying the rent, and that rental covers all the depreciations, interest, overheads, maintenance cost, and the profit margin. Okay, uh, sometimes the lessor typically may be a finance company, like the leverage leasing, or they purchases initially the equipment and then leases it to the lessee for a period of time as per the lease agreement. Okay, and after the end of the economic life of this particular asset, the ownership of the asset still remains with the lessor. So that is the advantage of the equipment leasing. Okay, and next one is that um, the second classification is about the real estate leasing that will be discussed in the coming classes. Okay, so these all about this particular topic, and in the next portion we will discuss about the what are the various types of, or what are the various classifications of equipment leasing. Thank you.